let's get started. Hope you guys are doing well. I'm going to share my screen. Actually, I'm not going to share my screen yet. We're going to have a little powwow real quick. So real quick, how you guys doing? How you been? How are your trades going? It's a different environment, and I'm seeing a lot more people say that this is a hard environment to be in. And some people have said they've been killing it, so that's always the case with everything. But how are you guys doing? How's your trading going? You can put it in the chat. Chat. Tough. Yes, that's a great one word. I like that. Spinning the wheel, slow. Yes. Those are all app descriptions. So, have you guys ever put trades on in a VIX under 15? It's been a minute. It's been a couple years. Yeah. I was having a conversation with some buddies, option traders here in Knoxville a couple of days ago, and they were like, "This is like crazy territory. Like this VIX is slow." And I've turned, because I'm also a dad. I've turned into like that dad that just like talks about how walking to school in the snow. But I'm that guy with the options with option stuff, and so this is not my first rodeo with like a low VIX, but I do recognize that it is very, very different than the environment we've been in over the last couple of years. And I also recognize that options growth has exploded over the last couple of years. And so it makes complete sense, and you shouldn't feel guilty if you're sitting here being like, I don't have any idea what to do in this market. This market freaking sucks. I'm getting no juice for anything I put on. I don't know what to do. You're not alone, right? I was doing a podcast the other day with someone, and they asked me about what my trades are right now. And in full transparency, I'm not trading much right now. For those of you who know Wizzy in the group, we were talking the other day, like I play a lot of chess right now. And it's not because I'm necessarily scared or anything like that, but I just have been down this rodeo of a 14 VIX before, and it's not my favorite type of trading. And I'm in a point in life where I don't necessarily need to trade. I'm not, trading for 100% of my income and all that stuff. So I personally am sitting some of this stuff out and just watching and kind of putting on some trades that are not normal trades for me. But I just want to say straight away that you shouldn't feel bad if you don't know what you're doing right now. Because, if you're new to this is the first time you've seen it. Like, think about like the NBA. I don't know if you guys like NBA, but it's the best sport. So sorry, international people who like soccer or football. But basketball, here's the crazy thing. You can go through a 7-game series, and you might sweep the people, you might win a 7-game series, and you go through it and say, like, we own that team. We made the adjustments necessary. We killed it. But then you get to a new team, a new round. And whereas the last team played small ball and they shot 40,000 threes a game, this new team is slow, and they've got this big Serbian white dude that just has more assists than points oftentimes. And it's just a completely different game. Right now in the options world, we're playing a completely different game. And so you have to kind of adjust what you're doing. That's my rant. That's my dad rant. We'll get on to the trades. But I will say there are some heuristics, and a heuristic being like, I can't prove it to be true, but I find it to be true. There's certain heuristics with this stuff that I think are true to form. And so if you look at the very top, I posted it, let's see here, where did I post it? I posted it today at 11:57 a.m. in the Cigar Lounge channel, in the chat where you guys are chatting right now. I'm going to post it again because I forgot I had it saved. This is from my mentor. He's been on the program before, Mr. Dan Sheridan. the godfather of options education. And I took a course from him a couple of years ago, and I highly recommend, especially in this environment. If you find yourself lost, if you find yourself needing to adjust, go seek out those old dogs. No offense to Dan Sheridan. He himself would call himself an old dog. Go seek out those guys that have been through this before, because they just know that they know the game. They know how to make the adjustments and all that stuff. And so, but in general, one way you can think about this stuff is in high volatility, and this is funny because this screenshot is taken in 2017. So high volatility in 2017 would be a VIX over 18. And that right there should go to show you how much the options landscape has changed in the last 4 years since COVID. A VIX over 18 was really high when you were trading in 2017, 2016, 2015. Like it is completely, and again, I feel like this mean dad when I'm talking to my 21-year-old daughter, and she's talking about how hard life is, and I'm like, snow, walked naked in the snow. And she's like, why were you naked? Grandma gave you clothes. And I'm like, don't worry about it. But I'm always that person with her. A VIX of 14 is well within the normal distribution of VIX. So if anything else, don't, if you want to stay in the game and you want to be a good options trader, don't fall into that trap where people start yapping and complaining and being like, this is unprecedented. It's not unprecedented. This is well within the range of a historic VIX. Is it on the low side? Probably, but it's not that much on the low side, honestly. I mean, I think 15 or 16 is the mean through history. So we've got a long way to go before VIX is, extended to the downside. I've traded in a 9 VIX before. If you think premium's crazy right now, wait till you see a 9 VIX. And will we see a 9 VIX? I don't know. It's pretty rare, but who knows? Who knows what's going to happen? So anyway, I'm saying all that to say, why, last thing, and then we'll get into the trades. Why would a VIX 15 or lower lend itself to calendars? Let's think through with the Greeks. Let's be math people today. Why would a VIX 15 or lower work for calendars? Theoretically, yeah, vol should revert to the mean. So if it's below the mean, it should revert up. Therefore, we should try to play that a little bit. We should include Vega in our arsenal. We should make Vega work for us. Why would a double diagonal, and for those who are newer to options and maybe have never traded double diagonals, they think of a condor, but the longs, an iron condor, but the longs are further dated out. So you might sell a 3-day shorts on the put and the call, and a 6-day on the longs of those. That's a double diagonal. Why would that work in a VIX 15 to 17? That one's always the trickier one. Yeah, you want a little bit of Vega protection, right? You want a little bit of Vega protection, but you're worried that it could still have a vol crush because, again, in 2017, 2018, a VIX of 18 probably was about to get vol crushed. A VIX of 20 certainly was probably, statistically speaking, about to get vol crushed. The unprecedented part, honestly, of trading in the last 7, 8, 9, 10 years is that we have had a vol environment where for 3 years we stayed above 20. That's crazy. Like when people talk about this is crazy. No. What we had the last 3 years was crazy. So I hope you enjoyed it. Maybe we get back to it because it was really fun. Anyway, let's get going now. So I'm going to share my screen. Can you see this? Can you see this old screen of mine? Sweet. Okay. I'm going to keep going. I'm going to switch back and forth between screens So if you have any questions, I'll get to them here in a second. So just put your questions in the chat. So what this is, I'm straight away going to share this. This is a portfolio of, I believe, 6 trades. Are there hundreds of trades you could do? Yes. But this is just something to get you thinking. Just putting the old thinking caps on. And I want to go through these, and I want to look at some basic things. So real quick, if you look through the portfolio, with the exception of the last one, all of these are a max VIX of 15. So they are built for this environment. There's no shenanigans. And because of that, these are not trades that have been put on in a lot of years. These are all trades that would have been put on really up until probably 2019, 2020. So with that being said, I want to start with our good friend, the double calendar. Okay, and this again is my personal mentor, Dan Sheridan. This is a double calendar that he taught me 6 years ago. And I want to show it really why it works in certain environments. So this is ran 2016 to June 8th. Yesterday, and you'll notice that it doesn't go past 2020, but I'm going to share this real quick and go. All right. So what this is just a classic double calendar, and there's a couple caveats as always. All life is full of caveats. We are going to sell the 28 delta put, and we're going to sell the 29 delta call. That's 9 days out. We're going to go 2 weeks past that for the longs. We're going to buy the put that's the same strike as that short, and we're going to buy the call that's the same strike as that short call. So it's a 9/23. So real quick, why 2 weeks out? If you have joined Option Omega last year when it was DC Fest, we were doing like 1-2s, 1 day, 2 days. Why would we go 2 weeks out between these shorts and these longs? That's a lot of time. It's much more expensive. Why would we do that? Remember, DCs are debit trades, so we pay a lot more for this. Any takers? It's okay. Rosebud's coming through in the end. I'll give the answer and see if it matches Rosebud's. Yep, that's exactly right. Correct. In a short VIX, a VIX under 15, we definitely want to be long Vega, right? Because yes, VIX could go to 9, but VIX is probably, statistically speaking, going to range from 14 to 20. Statistically speaking. It can go lower. Obviously, it can go much higher. Statistically speaking, and honestly, I haven't seen it yet, but I'll probably say this when it happens. Really, probably it could be 12 to 20. A VIX of 12 to 20, that's just the historically number of days trading with VIX. That's what you're going to be in, 12 to 20, okay? So we definitely, when VIX is under 14, or especially under 15, we definitely want to be long Vega. And so this is a long Vega trade. And the farther you go out with those longs, the more Vega you have in your Greeks. This is also going to give you, because you have 9 days, which is plenty of time. This is an interesting trade because it's going to be long theta and long Vega. And I love those trades. Those are that's my favorite type of trade. Long theta, long Vega. You've got time. It has to move quite a bit in a 1 day spike to kind of get really wrecked on these. You'd have to have a huge overnight move to get wrecked. You've got time to breathe. And in a low VIX environment where everyone's like, there's no premium. That's correct. There is very little premium. But so forget that for a second. Let's use the Greeks in our favor. And what can we use in our favor? Well, when there's no premium, let's bring some Vega in to work for us. There's more than one Greek that can work for us in these trades. So let's get the Vega in there. So we're going to open the trade at 10:30. Trades in previous iterations, we open them at 9:32 in the morning. We open them up right when the market opens to capture some juice and stuff like that. Well, with these, because it's 9 and 23, get used to those summer trades. This is nice. You can let it breathe a minute. Like, let the market do its thing for a second, and then open it up at 10:30. We're doing this every day. I am using exact DTE on this because I really want to try to keep the shorts and the longs at a 14-day difference, right? And so I want to make sure that's in play. We're allocating 20% of our portfolio up to 100 contracts per trade, so there's no madness going on with like putting 4,000 contracts on. And we're doing this only when VIX is a max of 15, okay? Very, very simple exit conditions. We're going to take 10% profit, or we're going to get stopped out at a 12% loss. Opening fees, $1.70, put slippage on of 5 cents, require 2 hits at the profit target. So we're punishing it a little bit. We're trying to make it realistic. And as you can see, this performs pretty well. Again, are you getting exponential growth? Well, it depends on who you ask, really, but this is a fine trade. You should not feel bad about this trade, is the way I put it, right? This is probably a historical mean type trade. You know, like this is going to work well for you. This is going to treat you well. Now, I say that, and as always, options involve risks. They're not suitable for all investors. Everything I'm saying is backward-looking, not forward-looking. As always, you should consult with your financial advisor before placing option trades. Anything I'm talking about is purely for entertainment purposes, not for financial advice or anything like that. So, with that being said, though, theoretically, this will treat you well. This is a kind of a nice. These are a nice little trade. Touch on the drawdown. You'll have peaks. What will kill this trade is a sustained move down or up, right? Like if it just moves and you're constantly having to take it. If it's breaking the shorts, or in the case of a DC, if it's touching both strikes within like 2 or 3 days every time, that's gonna hurt you, right? I didn't look at SAFX, but my guess would be with 2017. If I remember correctly, those Trump years, early Trump years, the market went on a little tailspin. The market just kind of, probably VIX went down a lot, I think, during that time frame. And then also there's perhaps some sustained rallies. And both of those will definitely kill you. One of them will kill you if it happens very fast. So if you put these on and in a month or two period, VIX is just getting slaughtered, you probably wouldn't work. Like, for instance, we could change this around. You can test it. Feel free. You have the link now. Everybody who's a subscriber. This probably won't work well. A VIX down, a VIX from 20 down to 14. That's probably not going to be a great trading period for this. But again, I personally, for right now, the way I would look at it is say, yeah, just don't put them on if it goes above 15, or get out when it goes to 15. Right? Get out of that trade. But if we stay under 15, I feel confident in this type of setup for a low VIX environment, if that makes sense. Those are great questions. Good questions. Any other questions about this trade? Cool. So, again, the point of these is there's more than two Greeks. There's more than delta and theta, right? There's other Greeks in play. And so a low VIX gives you an environment to maybe get some more juice out of the Vega than when a VIX is 30. You know, VIX is 30, you're going to get tons of premium because of high IV, and you're going to milk it down. It's reverse on a low VIX. We want it to revert up a little bit, so we're going to play long Vega on that. So let's keep going. Let's see here. And shout out, as always, to Dan Sheridan for that. Those type of trades are just his bread and butter. Like, he explains it a million times better than I could. But I wanted to do it because I knew, like, I was trading in this VIX environment. I was learning from Dan in this VIX environment. And I wanted to give him a shout out because that's a great trade. Keep going. Let's look at a butterfly. Okay. Now, this butterfly is interesting to me. Rosebud, you're going to be sad today. I don't have any 0 days today, and partly why is because the data is not out yet for that. Meaning, 0 day expirations, yes, they were 3 or maybe 2 or 3 for the majority of the time pre-2020, but we just don't have it. That's the nice thing about Option Omega. I'm very excited. I really, personally speaking, I kind of want it to stay low VIX for the next couple months just so that we can have some data and then formulate some trades from 0 day. But we're just not there yet. We're a couple of days in to this new environment for the first time where we have 5 day a week expirations. So, but I want it too. We all do. I know. It's a race. It's like gold mining. Every day I just sit here and try to formulate stuff, but today's not the day. So here's a butterfly, and this butterfly is interesting. Now I'm going to get kind of technical for a second real quick. This is an all call butterfly. You're selling it's 15 days out. Again, we're doing it every day. Max Vix of 15, opening it at 10:30. We're selling the 50 delta calls. We're buying the 63 delta call, and we're buying the 37 delta call. Now, what's interesting is you could also run this, and actually, if you're worried about like an imminent drop, what you could do with this is you could actually make this. If you take this 37 delta call down to a 35 delta call, that'll actually get you like 1 or 2 short deltas per contract. And so if you wanted to be a little bit short into this, you could do it. But there's a theory I have about that, that when you're under 15 VIX, it's actually indicating that we're in an up rally. And so I personally, when I was trading in 2017, I was always short deltas because that's how I was trained. At this point, I would say there's probably other ways to be short deltas, or more importantly, in my mind, be long gamma to a downside play, that I don't want my income trades to necessarily be tilted that. So we bump it up to 37, and at least my theory for this test proves correctly. It vastly outperforms that 35 delta. Does that make sense at all? I know that's a little technical from a delta standpoint. Basically, if you buy a 63 delta, a 35 delta, and sell the 50 deltas, you're going to be 1 or 2 deltas short going into that trade. This is neutral. You're more or less delta neutral. So as you can see, this was a little surprising to me how well this did, and it's interesting too because you don't have a stop loss. So theoretically, you can get wrecked on a big loss, but what it works for a couple reasons. This is really interesting to me. Butterflies, they always get punished with the 2 profit target hit. If you've ever traded butterflies, they jump around all the time, like the profit. And so your butterflies, this is a little pro tip. When you're testing, if you're testing butterflies, if you're taking profit, always do the 2 hit profit target, because it's going to make it much more realistic. And it's also going to make your trade suck a lot more, which is what we want when testing. We want to find winners. So this one's intriguing to me. It's got the punishers on, and at 10%, taking profit at 10%, you just have an outrageous win percentage with that. And again, this is a pretty big data set. I mean, you're putting 656 trades on, you're winning 606 times. Like, that's pretty intriguing to me. And this feels good for those who like income trading and like depend on income trading. This, more than any of the other ones we're showing today, feels pretty good to me, because again, this win rate is massive. It's crazy, and it does pretty well through time. So like this MAR ratio in this Kedger is actually a lot higher. It's just that we're running it to 2023, even though we haven't ran it since 2021. That makes sense. So it's skewed. We have these 2 from this year, but other than that, the last time they ran this was 2021. And it just kind of does really well. Like, again, you're setting a butterfly. Why do you put butterflies on versus condors? What's the premise of that? Any takers on that one? Butterflies are when you think it's not really going to do much of anything, right? It's just going to sit there. Now, we've rallied incessantly this year, but if you look at the days, and I look at people's complaints, and I look at how the market's going and all this stuff, largely, the market sticks to these big levels. And you can call them gamma levels. You can call them like the 25, 50, 75 O's spots. The spots that are nice, that they just kind of gravitate to. Ben, that's interesting. It just kind of sits there. And so putting this on every day is one of those things where you look at the average days in trade, you're in this trade about 5 days out of 15, right? And so you're putting them on any given time. You might have 5 of them on, right? And so it's an interesting play because you're kind of always taking stuff off and always putting stuff on, and you always kind of have a lot of spots to get 10% if the market drops down 15 points, drops up, or goes up 15 points. It's kind of like you got a bunch of like little valleys, right? And so, no criticism. Yeah, I get it. So again, that's an interesting one. If you've never traded butterflies, that might be something to take a look at. Let's get more interesting now. Let's see here. Okay, 5, perfect. Let's do what I call the lumpy DC. Now, straight away, you're going to notice this is a huge drawdown. And that's okay. But this is an idea factor where this is not a trading service. I'm not saying put these on. This is for educational entertainment purposes only. But it's to give you ideas and things to think about, things that you can take home and test. And this was an interesting test to me. The next two are pretty interesting. If you look at this test, we are selling, it's a double calendar, but the double calendar is a little bit more skewed. We are selling 2 50 delta puts that are 14 days out. And we're selling 1 35 delta call that's 14 days out. And then we're buying the same strike longs 2 weeks after that. Max Vix 15, profit target, we're just taking 10% and require 2 price targets and all that stuff. This is interesting because it's an outrageous win percentage. You do have a massive drawdown. And why would you have a massive drawdown for a trade like this? Any thoughts? Well, with a debit trade, you definitely can get smacked, with the drawdown. And what happens is if you're doing it daily and then we have just a couple big days down, you can definitely have it. Like looking at 2018, there was a pretty big drawdown right there. Well, what happened 2018? Here's the secret why I kind of like this. That's exactly right. It's a good job. This is why I kind of like this. And we actually took this out of the screener. I want to get it back in. But there's 4 million things that other people who are more important than me want, which are you people. So what I would personally do on this type of trade is I would not put this on if VIX was above 15. So make a mental note maybe. Because 2018, yes, VIX went up, but VIX did not go up a crazy ton. It didn't go to 30, I don't think. But I remember that fall of 2018, there was a pretty massive drawdown where you would have days that kind of stayed the same. Next day it drops down 1%. Maybe it rises 1% the next day, maybe it goes down 2%. But it was a sustained drawdown. And I guarantee you that VIX went over 15 at that point, unless it was already at 9 or something like that. You'd have to check the 2018 data. But so this would be my thing, is I actually think you could eliminate a lot of that drawdown if you held off to VIX when VIX was over 15, right? But otherwise, this is a really intriguing play because, again, there's a couple heuristics, a couple premises we're going into it with. When VIX is under 15, I presume that the market is going up. Or I presume at least that the market's not going down. The market's just kind of doing its thing. The market is playing the mean right now. It hasn't gone to the poles where it needs to revert either direction. It's just kind of, it's doing its thing, It's the 401k dudes. That's exactly right, Ben. I feel like we're now approaching the season where all of our financial advisors, it's happy season for them, where they get to say it with more conviction, the market always goes up, and all that stuff. This is their happy point in life, and let them have it. They've had a rough 3 years. Just let them enjoy this. I've got good friends that are 401k managers, and just let them have it. Let them have this time, because we had our time for the last couple of years. So, saying that to say, with these type of trades, because I presume that the market in general is going up when VIX is under 15, skewing a double calendar, you're still getting Vega, right? You still have Vega, But your long deltas and your long theta, that feels good to me. Like that feels like a good environment trade. And if you've heard me say it like 100 times. I'll keep saying it. When you're trading options, remove as much as you can. It's impossible to remove all of it, but remove as much as you can the noise of the macro guys, the noise of like the herd option traders. Remove that stuff and think mathematically. Think in terms of what this contract that you're actually selling and buying is giving you. And it's giving you a lot in a low VIX environment. It's giving you, there's different shades of it. There's different dynamics at play. And so a long Vega, long theta, long delta trade, under 15, it's pretty intriguing, right? Any questions about that one? And so I'm sure I'm not the one who came up with this, but I named it the SPX Lumpy DC. And it's lumpy because one side is greater than the other side. Any questions about that one? All right, two more. Same thing, but with Apple. Dun, 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 dun. We now have Apple in our repertoire. So we can test things. And what is Apple? Apple is its own index. That's the way I look at Apple. Apple is its own index. Apple doesn't do things that other stocks do. Apple does things that other stocks don't do. And so this is the same premise, the same idea, but I wanted to extend it to an equity to show you. Now, strangely enough, I didn't put it in here. Doesn't work with Tesla. Why do you think it doesn't work with Tesla? That idea of just kind of being long and Vega and all my little nuanced things I just said. Why does that not work with Tesla? That's exactly right. Tesla's a meme stock. That's right. Tim Cook doesn't tweet, and Tesla does. Tesla tweets so much they bought it. We put Apple and Tesla in because we wanted those two. Liquidity is so important in backtesting that we don't feel comfortable putting equities that don't have liquidity in. And you might think to yourself, like I love NVIDIA. I think NVIDIA would be great to have in there eventually. Maybe we will. NVIDIA has great liquidity right now, but it didn't always have great liquidity. Tesla and Apple, from the beginning, have had great liquidity, right? Historically, they have liquidity. So we pick those as proxies because Apple is that classic. It's literally what your 401k people are doing. They're just allocating capital to Apple every year, every quarter, whenever they do it. They're reallocating capital to Apple. Tesla is the original GameStop. It's the quintessential meme stock where it's dormant for a long period of time, drops down for a long period of time, and then just goes up 2,000% in a short period of time. It's crazy, right? And so we use these two to test all other things. And saying that to say, you might have another stock that you love. You might like Boeing. You might like GE. You might like other ones I'm trying to think about. The $800 burrito stock. You might be all in on the $800 burrito stock. Well, that might be something that you could test with this. Thank you, CMG. That's right. Again, but the premise of this is you're in a low VIX environment. Therefore, equities are probably rallying. Therefore, we're going to be long delta, long theta, and we want a little bit of Vega protection. That's it. I mean, that's the general premise of it. You're in this about 6 days, 6.5 days. And it's just an outrageous win percentage, which, again, shows me that in low VIX environments, those premises usually hold true. Stocks usually are maybe not in hard rally mode, but they're rallying, and or they're not doing anything, and or we have time to put longer dated trades on and take them off for a small percentage, 10%. This in and out, just happy trees, happy accident, right? Just let's be the Bob Ross of option traders. Final one, my personal favorite. If this is not for the income option traders, this is for those of us who got into options for tail risk. This is a very simple low VIX hedge. I mentioned earlier that I have gotten to the point where I don't like my income trades to necessarily be short deltas in a low VIX environment. And the reason for that is I feel much more comfortable putting that resource into a hedge that could pay off much greater. So this is a very simple hedge. I would like to think so, Ben. I would like to think that's the case. A very simple hedge. Every Monday, when the VIX is under 18, we're going to buy a 30% out of the money put in SPX. We're going to allocate 1% of our portfolio. So every Monday, we're putting 1% of our portfolio into buying puts. That might be one put, that might be 20 puts, that might be 1,000 puts, that might be 2 SPY puts, right? It doesn't matter. Every Monday we're doing that. We're putting 1% in. And we have 2 exit conditions. At a 200% profit target, we close half of those puts. And at an astounding 10,000% profit target, we close the other half of our puts. We've got slippage, we've got closing fees, and important on this, we want to pay at least $1, and the most we want to pay is $2. That's our criteria. Notice I didn't put 2 hits at the profit target, and the reason for that is with tail hedging, if you traded during COVID, there is a good chance that you will get an outrageous profit target if VIX is going nuts. When we have the toggle for ignore wide bid ask trade, you will have wide bid asks in an 80 VIX environment if we get to 80 or 50 VIX. If we've gone from 12 VIX to 25 VIX in a day, you're going to get wide bid asks. Accept it, understand it. More importantly, let it be to your profit because you're long gamma and you're not viciously trying to get out of a loss at any price. You are this rare opportunity where you get to set the outrageous price, and people who sold these 30% out of the money puts because it was easy money for years, they are scrambling, right? Now, what's astounding to me about this, because we've lived in an extraordinary time in options land, is you win 50% of the time, which is not usually what you think of with a hedge, right? But that's the cool thing about what we do here with the old option list mega backtester is you can test taking different percentages at different profit targets. And that's the key to this, because you're going to have plenty of times where you have a 100% profit target, right? So you can play around with this. But the premise is if there's a pop, that's probably going to be it, theoretically speaking. If there's a pop, it's not out of the ordinary that you might get 200%. If a VIX is 13 and it goes to 17 in a day, maybe you get a pop. Maybe the next day it goes to 21. Yeah, you definitely might get out 200%. You might make 200% on this, right? Especially if you paid $1.15 for it. But that's most of the time, theoretically, statistically speaking, that's going to be it, right? So what we want to do with this hedge is we want to take our chances and we want to keep playing. So we want to use that as house money, right? We want to take it when we can get it. So 200%. You could definitely, I did not test the trail stop, Eddie. I have before, but for this test I didn't. So feel free to run with it. Feel free to take this test and do it. Again, I kept this very simple. And again, that's my thing is I'm a tail hedging guy. So this gets much more complicated and you can make it much more explosive. But for this case, I just wanted to start with this to show that there are times where you get 5,000%, 2,000%, right? Especially in the last 6 years. Now, would you ever do this by yourself? Maybe you would. Maybe you would just put hedges on if you're me or something like that. But if you're also running income, this to me feels so great. You can feel so much better about these type of hedges when VIX is under 15 than when VIX is 25. It's just a world of difference, right? And so that's why I put it as a portfolio, because when you run this with a portfolio, you start seeing it together, right? You start seeing things that work out pretty well together. A hedge is a hedge, and so it's presuming that you're hedging something, and most of the time that means a long strategy. So, and these are super fun. To Ben's point, these are super fun when you are having strategies that are doing really well through time, but you want protection. The hedges just help you sleep at night, right? So, with that being said, are there any questions about that? I know some people left sad and disappointed today because we didn't have any zero-day trade. But I just want to reiterate, eventually we will, because the data is going to be there. But also, expand the horizon a little bit. Expand your horizon, get used to trading other things, It's good for you. It'll make you a better trader. It'll help you. You know, I encounter a lot of people who do very specific 0-day trades, and they're always to the drawing board of the next 0-day thing. And I get that. Like, I do that too. Like, I understand it completely. But one of the ways to grow is not necessarily to keep doing the 0-day stuff. Maybe you start adding some other stuff with your 0-day trades, right? Maybe it doesn't have to be all or nothing. Maybe you can mix and match a little bit. So we have thought about it and keep thinking about it. VIX is hard from a backtesting standpoint because if you look at the VIX chain, it is super illiquid in certain strikes. So that's strike one. Like, there's just a large swath of strikes that are very, very illiquid. And so you're constantly it's like a weird thing where you're constantly going to have like a wide bid ask on certain strikes, depending on what you put on. But then two, AM expiration is just a nightmare. Just to be honest, it's nightmare fuel for what we do. Because you're going to have people to be like, I put this on at 12 and it didn't, and it's like, well, VIX is a different thing. We are very interested in it. I personally would love to have it. I know Rusty and Matt would love to have it, but we want to try to do what's best for the community. And we think sometimes that could open more Pandora's boxes than it's worth. But we're looking into it. We're trying. I mean, we're not giving up on it. We're trying to think of ways to do it. So that answers your question. Any other questions about that on this beautiful Friday Knoxville, Tennessee day? We had a little cold snap. It's been like 65, 70, wearing my Bubble Gump sweater. So I feel very good about it. I am in Knoxville. Gold would be awesome. Gold will always hurt your feelings if you're using it as a hedge for downturns. Yeah, gold is fun. Gold basically is the ultimate low IV, dormant for years at a time. It's like a volcano. It's like the volcano of options. But it's like a smaller volcano compared to VIX or vol, equity vol, any of that stuff. It's just this thing where like every 15 years it goes up like 30% in a month, and then it just sits there for 8 years. So it's fun to trade. I like doing double calendars on gold, and I like doing condors on gold. And sometimes I even like doing long straddles on gold. TLT, TLT probably does have enough liquidity, although it's not great. And it's not great to trade. If you ever listen to Tasty Trade, they always bemoan TLT. TLT is one of those that I wish I would have bought in 2020, or sold. I wish I would have bought puts in 2020, honestly. But those are not. I'll put it this way: with those type of ones, we would love to do it, but there are other things that we think would benefit you guys a lot more than putting TLT in. Honestly. Any other questions? This is good. I enjoy it. Ben, that's very kind. Thank you so much. We are very excited for the future, and we're very excited about some things that we were working on. Not going to give anything away, but we know there's a lot of people wanting to do bots. So we'll see what the next couple months look like. All right, everybody. I hope you're doing well. I hope you have a good rest of your day.